Normally, when I sit down to make these stock pick videos, I bring you 3 stocks, 3 companies I believe are worth researching, worth owning, and worth watching. But this time it's different. The market has been on a tear. Valuations are stretched. Many companies are trading at near or all-time highs. And honestly, it's getting harder and harder to find real bargains. And I don't want to just throw in the third pick for the sake of keeping traditions alive. That's not what investing is about. So today, I'm only sharing 2 stocks. 2 names that I think stand out in this overvalued market. Both are trading far below their highs, and both, in my opinion, are misunderstood by Wall Street. And if I'm right, they could both deliver strong long-term returns when the dust settles. Now, this doesn't mean that there aren't other companies I'm watching. There are plenty I would love to own if only the price came down. But I want to stay true to my strategy. Only buy when the odds are in your favor. So in today's video, I'll show you the 2 stocks I like, why they dropped, we will briefly go through their financials, and of course, I will calculate their intrinsic value to show you why I think they are undervalued today. So let me share you my 2 picks for October. We start off with Lululemon. It has been one of the hardest hit consumer discretionary stocks this year, plunging over 50% from more than $400 to around $170. The decline is a result of several challenges that shook investor confidence. The first issue is weakening demand in the US, Lululemon's largest market. Comparable sales in the Americas segment turned negative, showing that the core customers are cutting back on discretionary spending. Also, this slowdown came at a time when management lowered their full-year guidance, trimming expected revenue growth to only 3% in 2025. And for a brand that has long been associated with rapid expansion, such lower growth was a disappointment. Profitability has also come under pressure. New tariffs and other ongoing issues should cost the company around $240 million, basically eating into margins. Combine that with inflation and other operating costs, and these factors have weighed on earnings potential. Another drag on the sentiment has been the company's product pipeline. Management admitted that recent releases have become predictable. With little innovation to excite customers, sales momentum has slowed and inventory levels have climbed. And this stands in contrast to the company's earlier success, as before it was seen as the trendsetter in the athleisure. Finally, broader macroeconomic headwinds amplify this issue. Inflation, weakening consumer sentiment, and reduced spending on discretionary categories like athleisure have created an unfavorable environment. Investors also punished the stock as part of the wider trend. Slower growth often leads to valuation multiple contraction, especially for premium brands. In short, a mix of weaker US demand, squeezed margins, limited innovation, and tougher macro backdrop explains why Lululemon stock has dropped so sharply in 2025. But all that does not mean that the company is dead. Lululemon still holds one of the strongest brands in retail. They have loyal customers and long-term growth potential. So to show you why I like the company, let's take a closer look at their financials and run my intrinsic value calculation to see why I still like the company despite the recent drop. So Lululemon is currently trading at around $175. And it's far off its all-time high of over $400 this year. They're trading at a fairly low 12 price-to-earnings ratio with a forward PE of 14, and they have this amazing 40% return on invested capital, especially for a retailer. On top of that, they have really low debt with the net debt to EBITDA ratio at 0.17, and we like it to be under around 2.5. And when it comes to retailers, their debt is usually much higher. Looking at their revenue growth over the last 10 years, it looks amazing, going from $2.3 billion to around $10.5 in just 10 years, which is basically more than a 4 times increase. Net income shows an even better picture, going from $300 million to over $1.8 billion in just 10 years, basically going up 6 times. On top of that, they have been consistently buying back shares, increasing shareholder value along the way. So far, everything looks great, no red flags. relax. Now this is what analysts are predicting for the company. For their revenue, they expect it to go from 10.6 billion to around 14 billion in year 2030, growing steadily each year. And as for their earnings per share, analysts do expect a dip next year, but they do see it rebounding and going all the way up to $20, compared to the current 15, which is around a 6% growth rate annually. Okay, so all in all, despite this upcoming dip, Lululemon seems to look really strong financially. So now let's calculate its intrinsic value and see what returns we could expect over the next decade. In the last 12 months, Lululemon did $14.65 in EPS. And let's say that the analysts are right and Lululemon will grow their EPS at around 5% for the upcoming 5 years. Even though Lululemon's EPS usually grows at much higher levels than 5%, let's keep it at 5% for the full 10 years. Also, let's say that their multiple will shrink even more and will go down to 10. And as you can see, if these assumptions come true, for a 10% annual return for the next decade, you could pay over $200 for Lululemon today. In fact, I just adjusted the numbers, and with these fairly pessimistic assumptions, it seems like you could expect closer to 12% annualized return over the next decade. Now let's say that their multiple expands to 15, and let's see if a company could bring us 15% annualized returns over the next decade. And as you can see, for a 15% return, it seems pretty much fairly priced. So yes, while Lululemon's stock price has been struggling, the fundamentals tell a completely different story. The company has low debt, especially for a retailer, surprisingly high return on invested capital, and consistent growth. And if they manage to fix their current issues, or the valuation multiples expand, the stock would easily deliver over 15% annual returns over the next decade. And even if they don't, a solid 10+% still looks realistic. And that's exactly why this is one of my 2 picks for October. Now let's move on to my second pick. The second company I chose for October is Centene. I already covered it in detail in my previous videos. I explained why the stock dropped and why I don't see it as a long-term problem. So I'll keep it short. In simple terms, Centene got hit hard after pulling its 2025 guidance. And on top of that, they reported higher costs in ACA plans. And the market panicked, sending the stock down over 50%. And even though the stock price is trying to recover, it is still down nearly 40% this year. But I see all these issues as a temporary pricing mismatch, not a long-term problem. Centene still has strong government contracts, steady cash flow, and one of the cleanest balance sheets in the industry. And in my opinion, at today's valuation, it's trading at levels that already price in the worst-case scenario. So instead of focusing on the headlines, let's look at their numbers. Let's look at Centene's financials, and let's calculate its intrinsic value so I can show you why I love the stock. Centene is currently trading at around $37, and it's down more than 30% this year. They're trading at a 9 PE ratio with a forward PE ratio of almost 25, which basically means that the upcoming year's profitability will go down significantly. Their return on invested capital is 7.7%, which is not the best but not terrible as well. And they have fairly low debt with their net debt to EBITDA ratio at 0.6. Their revenue has been growing every year for the last 10 years, going from 37 billion all the way up to 147, growing more than 4 times. Looking at their net income, if we ignore these 2 COVID years, we see that their profitability growth is really stable. On top of that, we were issuing shares until 2021. However, for the last 3 years, they started buying them back as they bought back more than 10% shares in just 3 years. Buying back more than 10% in just 3 years are exceptional numbers. Now let's see what analysts are predicting for the company. For the next 5 years' revenue, they still expect it to continue growing, but at a slower rate. And for earnings per share, they expect struggle in the upcoming few years, but they expect it to rebound by the year 2029. So yes, we see a quite large dip in the upcoming 3 years, but that is expected. And as soon as the company reprices their contracts, they should go back to normal. So with all this in mind, let's go to my intrinsic value calculator to see what returns we could expect from Centene. Alright, in the last 12 months, Centene did $4.11 in EPS. Now let's do a pessimistic assumption and let's say that the company's rebound will take longer and they will not grow their EPS for the next 5 years at all. And let's say that they will grow their EPS at only 5% for the 5 years after that. Keep in mind that before, Centene used to actually grow their EPS at closer to 10% annually. Let's be even more pessimistic and give them a terminal multiple of 10. And as you can see, with these, in my opinion, highly pessimistic assumptions, for a 10% return over the next decade, you could pay close to $46 for Centene today, when it's trading at 37. In fact, I just adjusted the numbers and it seems like with these highly pessimistic assumptions, Centene could deliver closer to 13% annualized return over the next decade. Now let's improve our assumptions a bit, and let's say that they will grow their EPS at 5% for the full decade, which again is still fairly low for Centene. And let's say that their multiple expands to the market standard one of 15. Suddenly, even for 13% return, Centene looks really undervalued. In fact, I just adjusted the numbers and it seems like Centene could actually return closer to 20% annualized returns. And again, keep in mind these growth rates for Centene are fairly low. So yes, Centene is struggling with profitability right now, but that's a sector-wide issue, not a company-specific one. As soon as they reprice their contracts, margins should start to recover. Beyond that, their financials remain solid, and even with pessimistic assumptions, Centene looks capable of delivering over 15% annualized returns over the next decade, and possibly even higher if the sentiment improves. So to wrap it all up, October isn't an easy month for stock pickers. Valuations across the market are high, optimism is everywhere, and genuine value is getting harder to find. That's exactly why I focused on just 2 names this time, Lululemon and Centene. Of course, both are far from perfect right now. Lululemon is dealing with slower growth, and Centene is fighting margin pressure. But underneath the short-term noise, both companies have strong fundamentals, solid balance sheets, and room for meaningful long-term upside. As value investors, we shouldn't chase what's hot. We should wait for quality companies to go out of favor, and we buy when the odds tilt to our direction. And that's exactly what these 2 companies represent to me. Patience meeting opportunity. Now, if you enjoyed this breakdown and want to see more, make sure you subscribe, drop a like, and let me know in the comments which stocks are you watching right now. And as always, guys, thank you for watching, and I hope to see you in the next one. Bye.